But I think one thing I will say is that while CMU is essentially a medium-term project, and we know that, I think it's clear we're going to have to look for ways in which we might front-load some of the ideas in this report to help in the nearer term to get this equity-led economic recovery up and running. And as I said at the beginning, I think the CMU now becomes a really essential complement to and a beneficiary from the recovery plan, because a large part of the recovery plan will be focused on solvency support and looking for ways in which we can, address what is going to be very high leverage levels post-COVID, a quite difficult operating environment post-COVID. Probably, as I said, low benchmark interest rates, but wider spreads, so not such an easy environment for debt. And so it's important that the recovery plan includes in it an element which supports solvency of companies, both large and small. And of course, what we can do then for equity markets as part of the CMU project will be then an essential complement to that. So maybe I'll stop there and let me hear what everybody else has to say. Thanks.
Thank you very much, John. Our next speaker will be Fabrice Demarginy, and I think all of you know him with his past role in Mazars as well as chairman of Mazars, but today I would very much like him to speak about his work as the chair of the next CMU high-level group, and I think that's been appointed by several ministries of finance. And to me, I think it was a very positive time at the time last year that member states took the initiative before the European elections to create the next CMU high-level group. And I think your report was very well received, Fabrice. I think it's obviously that member states and the European Commission need to, I think, collectively work on this project. And I think it also was quite encouraging, and you and I talked about that yesterday, that Macron and Merkel have made clear that we need more integration in various areas, digital and sustainability, John just mentioned, but also capital markets was mentioned there. So Fabrice, please.
Yeah, thank you very much, Rainer. And it's difficult to speak after Sean because he said the most important things and the priorities of the Commission, which I'm very glad to hear, because that really goes into the right direction. But I would say even before the crisis, we already identified a number of factors in the market, in society, that was calling for shift of priorities of the CMU. That was, of course, a low interest rate environment that makes savings of individuals and citizens very badly remunerated. And this is heavily challenged by an aging population and retirement issues. Sustainability, of course, now in society, something that is expected heavily. Real change of mindset. Digitalization is happening more rapidly than we expected 5 years ago. Trade tensions, so the paradigm of globalization has changed, and now regions or countries have to think about their self-reliance and autonomy. And quite importantly, Brexit has happened, so the key financial center of the Union has left, and we have to think about our capacity, financing capacity through the markets in the EU. And then comes the economic slowdown provoked by C-19. So that's why we recommended a real shift of priorities and concentrate on savings, investment, and sustainability. We even still continue to recommend that there should be a change in the name of this union to make it more easy to understand by citizens and call it a saving and sustainable investment union. But as you rightly said, things significantly will change post-COVID. You referred to the recovery plan, of course, which I hope will have an re-equitization piece, which is called actually also by the Franco-German initiative of last week. But let me illustrate indeed with equity how significant this is now, and maybe I can speak more bluntly than than Sean because he's waiting the announcement tomorrow. But if I read properly, there is a lot of political willingness to reallocate, to relocate, and create growth in what they call key strategic sectors. Immediate one is pharma, medical equipment. It could be something else. It could be data treatment and storage. But if the intention is to relocate into the Union a number of key strategic sectors, it means that a number of decision centers, production plants, research and development centers will have to be relocated to Europe or created from innovative solutions. All these will need capital. There will not be strategic autonomy or European sovereignty without capital. And you can use the debt market, but for that you need a solid capital base. And capital of corporates in the EU compared to other regions is weak. So there is a huge room for progress there. So that's why I think the focus on equity is extremely welcome. And but then there is a number of things that we miss. And that's why we consider that there are absolute priorities for this second phase of the CMU that should be taken on board. The first one is that we miss long-term available capital. So we have to generate much more long-term capital that will be invested in equity. That's the only capital that really creates solid base for growth. And for that, pensions is an issue, and this is a national issue, of course. It's sometimes a social choice. It's not an economic choice or a capital market choice. But nevertheless, member states should be obliged to have multi-pillar strategies, be it Pillar 1, Pillar 2, or Pillar 3, but they should be strategies on which they report to the EU and which force people to invest on the long term, meaning creating and generating more long-term capital available and that could be invested in equity. Another solution is all kinds of workplace savings, including share ownership programs that will create a more solid base for capital ownership and will respond to the needs of the citizens that have the savings badly remunerated today. In private equity, we are weak in one point, which is late-stage private equity. We are quite good in financing the first phases, but there is in the chain one weak point, which is late-stage private equity. This is not for legislation. This is really for building trust on key players, creating critical mass, keeping the right talents or bringing the right talents. The other way of bringing, of course, capital to innovation is to facilitate significantly, making much more proportionate access to the public market. So IPOs of mid-caps, it's a huge priority. But on the other hand, equity holding should be incentivized because those who will have that capital available, meaning insurance companies, pension funds, should not be discouraged to do so. And today, as we all know, Solvency II and IFRS 9 is a disincentive for equity holding for insurance companies, so that should be targeted. And for illiquid assets, definitely Europe has a vehicle, which is the LTIF, that could be like the UCITS is worldwide reference for liquid assets. We should create a real vehicle for illiquid assets, and LTIF is a perfect candidate for that. But as you said, all these can work if we have a critical mass and competitive and integrated ecosystem. And there, Europe has been much too timid, mostly by measures at national level to disinhibit mergers of banks, of market players, asset managers, creation of EU data providers, payment systems. There's a number of players that could combine forces to create a more integrated market, and there some more ambitious strategy should be set. The same goes for the digital finance. I think the time where we were testing things in sandboxes is finished. Now we have to move to a real industrial, ambitious digital finance action plan, which is a key component of the next CMU. And last, on about creating a more integrated market, I think we have to definitely declare the end of supervisory arbitrage. We are not anymore in the time of regulatory arbitrage. That's dealt by the single rule book, where 90% is done at EU level. But the real fragmentation happens when we come to supervision. And there we need really to find a way to stop supervisory arbitrage, meaning allocating the supervision where it's the most efficient. Could be national, could be mutual recognition, coordinated by ESMA, could be directly done by ESMA. That should be studied segment by segment and provide always the most efficient answer. We believe that for exchanges and post-trading infrastructures that are active in equity, because equity is the strategic point, time has come for that to be done directly by ESMA or indirectly by ESMA, but with a power of imposing a convergence at ESMA level. Now, very quickly to finish, this of course must be done in consistency with the EU agenda on sustainability. The Green Deal and all that, it's a society choice, which we will not come back on that. And the growth for future is in this area. So all what is about taxonomy of investments should be now promptly implemented. I would say even non-financial standards on the issuer side should be a priority. If we want to be serious about sustainability, there should be the mechanism to achieve that in a very efficient way. And last but not least, I still have two. There is no financial center competitive, strong and efficient that has not a strong currency widely used on the global markets. Therefore, the international role of the euro that was always very timid, and there was caution.
Fabrice, you just have frozen. I think he has. Fabrice, we just started on international role of the euro. Then there was a. Yes, we can, but there was a short interruption. We start maybe with international role of the euro again.
Yeah, I think we should be much more ambitious now, and that means having a lot of euro-dominated assets, and there are candidates for that. One of them is all securitization of loans. We all know the discussion about securitization, but they are euro-denominated, and we can make that market more efficient whilst respecting the conditions on which this was democratically accepted to do, but improvements are possible. And of course, if the union on the debt market finds a reference asset, not to say a safe asset, but a reference, a benchmark for the debt market, that would be an efficiency factor that should be promoted. And we all can believe that now that sovereign debt will be issued massively, we will find that. So that's the key priorities, I believe, that would significantly help the phase 2 of the CMU, but that will take time because we all know part of this is at national level, it's member states to take action, part of this is legislative action at EU level, which always takes time. Some are very technical, so that's why there is a need to have a vision here. that is quite important. And my last comment would be that there is an accelerator of that it's possible in the current time, which is what Sean alluded to briefly. I think if part of these funds that will come through the recovery plan could be allocated to investment in equity and shares, with a sort of strategic EU fund that will identify those sectors that will help companies to have sufficient equity base and capital to raise by themselves the funds they need for growth and relocation of strategy, it will immensely help. Sorry if I've been too long, but that's the bulk of my remarks.
Well, I think a very good contribution. Thank you, Fabrice. Next would be David Wright. And I think, again, he requires no introduction given his many years of service at the European Commission, IOSCO, and now at Eurofi. He's currently also the co-chair of the CMU High-Level Forum and supervising the work on capital ecosystem. And obviously, I think that's a work that now has gained much in priority, in my view, and I think it needs to be a game changer for European recovery. No pressure on the group. We're, I think, all waiting for the final report, which is due to be published now very soon in June. And I think, obviously, above all, I would be very keen, David, to hear your perspective on your personal thoughts on what Europe needs to do now.
Well, thank you very much. Thank you very much, Rainer, and good morning to everybody. Well, listening to Fabrice and Sean, who have described the key issues of CMU, which I fully agree with. I mean, we've never had a better chance in a way to move forward. This is the moment. All the stars are aligned, but there's one thing missing, and one crucial element, which is unless there is a political agreement at the highest level between the European Council, heads of state and government, the European Parliament and the European Commission on a programme, on a package, with deadlines, monitored and enforced, it's not going to happen. It simply will not happen. It'll be death by 1,000 bureaucratic cuts. So the politics here are absolutely vital. I believe on the substance, as Fabrice and Sean have said, there's a lot of agreement, The crucial element now is the politics. And I've said this for many years. I keep on saying it. And I believe that Europe has to refine a sort of collective spirit of compromise, but also determination to move forward. And now is the moment, frankly. And if we don't do it now, what Sean said is absolutely right. The recovery will be slower, longer, more painful. We'll continue to lose competitiveness. We won't develop our small companies into world beaters. You know, today, the European Union does not have one company, not one, in the top 15 digital companies in the world. And this is serious, in my view. Not just serious from a strategic point of view, but serious from a technology point of view, and of course employment. If you look at these big companies, how many people they employ, we have to be really concerned about. We need European companies, startups, mezzanine, all that finance has got to work. And Fabrice mentioned one of the elements which I'm very interested in, the LTIPs. We have to find a way to translate those prospects into listings on European exchanges and development on European exchanges. Now, I'm not going to go into all the different elements that we've been discussing. If you read between the lines of what Sean and Fabrice have said, they've covered pretty well all the issues. I think there are other elements which we haven't discussed, such as corporate governance, for example, which are immensely important. The tax regimes, of course, can stifle any increase in equitization in the European economy. As was said, we've been working very hard under a superb chairman, Thomas Wiese. We should be ready, I think, in about 10 days. Final drafts are circulating. So hopefully we'll be ready in 10 days. And then we're going to lob the ball towards the European Commission, who have acted most efficiently as our secretariat. So the main point I want to make today is never have we been so converged on the substance. Can we be converged on the politics? That is what I think is absolutely crucial, Rainer. Let me stop there on this particular point.
Well, thank you very much, David. Guillaume Guillaume Prache is the managing director of Better Finance, whom I think all of you know, and obviously representing the key interests of end investors in many fora across, I think, the financial sector. He also, I think, has a vast experience as a CFO and asset management. And re-equitizing the economy will be a huge task for governments and the private sector, yet citizens in the EU, in my view, still hold a huge amount of non-interest-bearing cash on their deposits, and the participation in equity is still very low. So I think you're doing a lot of work on that area, Guillaume. So what can we do to activate, really, in this crisis, finally, the capital of citizens when Europe needs it to restart the economy?
Thank you, Rainer. Good morning, everyone. And thanks to FESE to give the floor to a representative of individual investors and pension savers. I think it's an excellent title of the conference, the Capital Market Union and COVID-19, Re-Equitizing the European Economy. First, because EU households are the main source of long-term funding of the economy. They are the largest pool of savings by far, and as you said, Rainer, currently not so much, at least directly, in equity. Equity is a unique animal. It's not only the best long-term funding instrument for the EU economy, not only for the users, the recipients, the issuers, but also for the investors, and long-term track records of portfolios of diversified equities prove it, especially when you compare it to other retail so-called package products. There is ample research on this. But it's not only a financial instrument. That's why it is a unique animal. It's not like other financial instruments like loans, bonds, because it's also a title of ownership. It's a title of ownership of real businesses and assets. And with ownership come rights, the most important one being the voting right in the General Assemblies, and also responsibilities in terms of engagement and in terms of sustainability, as, for example, Fabrice mentioned. At the end of the 1960s, EU households held directly close to 40% of the EU listed economy, of EU listed companies. Today, it's a little more than 10%. So re-equitizing the EU economy really means first to revive the equity culture, to start with households, and then I will say a word also do it with politicians. With households, where can we get informed on equities as EU adult citizens? I'm not talking about financial education, which is of course needed, but is not a competency of the Union. There are two possible places. The retail point of sale, of course, so the retail financial intermediaries. That's the first one, the obvious one. Unfortunately, there it does not really happen, or it's very limited. Simple listed equities and listed funds, equity funds, low-cost index funds called ETFs, exchange traded funds, are not talked about, not promoted at best, and too many times even strongly discouraged. And that is mainly coming from inducements. I'm not going to talk about inducements today. I am a member of the HLF CMU, the High-Level Forum CMU, and we have made proposals to improve this situation on the prevention of conflicts of interest arising from commissions. I would like to focus today on the other possible place where adult EU citizens can get can hear about equities and what it can bring to their portfolios and their financial well-being. It is the workplace. The workplace where you have sometimes the possibility to be exposed to corporate pension plans and to employee share ownership. One beauty of employee share ownership is that you don't have inducements there. You know, it's not mainly driven by sales commission, but there are many other powerful advantages. And really, we believe that employee share ownership, and we issued a press release a few days ago about this, can be a powerful help in addressing the COVID-19 financial crisis, not only financial, economic, social, but also key for the success of the Capital Market Union. First, because it is, in our view, a powerful means to rebalance the EU funding between banks and capital markets. Because today, employee share ownership is totally underdeveloped. If you look at the US statistics, and bear in mind that US is only 300 million people, we are 500 million people, at least we were up to this year. You have more. You have in Europe. You have about 375 billion euros invested through employee share ownership in listed companies. In the USA, again for a smaller population, you have 2.5 trillion US dollar invested. But that's the tip of the iceberg. The bottom of the iceberg is when you look at unlisted companies, SMEs. In Europe, employee share ownership in SMEs, 13 billion euros. In the US, with the ESOPs, the employee stock ownership plans, 1.3 trillion, 100 times more. So if we were only reaching the level of the US with a lower population, the EU 28 market cap would go up, other things being equal, of course, by 30%. And private individual equity flow investments into SMEs would be multiplied by 100. That is why we say this is the most powerful tool to make the capital market union succeed. But it's not. This again is just a little piece of the iceberg, because studies show that people, especially in the UK, who have become employee shareholders, more than half of them have later opened an equity brokerage account. So this is just only the direct effect. Strange noise. Okay, and so this is also a very powerful tool to increase financial literacy and knowledge in equities in households. Also, in terms of, and Fabrice also talked about sustainability, about ESG, environmental, social, and governance issues. First, studies show that employee share ownership is increasing the resilience of businesses and reduces employment fluctuations in times of economic crisis. That is why it is also crucial with the COVID-19 impending, not impending, happening economic but also social crisis, when people will get out of part-time unemployment benefits. And so that helps socially. It is also helping on the environmental and on the corporate governance side, because also studies shows that companies where you have a high level of employee share ownership tend to have increased responsibility and hold their immediate environment in higher regard, because they internalize externalities. And they also have a more long-term focus. The Commission has said several times that many companies still focus too much on short-term financial performance. Also, a lot of studies show that corporate governance and long-term horizon are better taken into account in companies who have a large, an important component of employee share ownership. The European Commission has worked on this. There was a pilot project in 2014, but which was not followed up. There was a CMU action in 2017 to promote awareness on employee share ownership, which has not been followed up so far. But with the COVID-19, with this economic, social, financial crisis, which is unprecedented, which is unique, with the challenges to the EU capital market integrations, Brexit, which are also unprecedented, we think it's time, and I think other speakers said that better than me, but it is really time for exceptional, bold, and creative solutions like employee share ownership plans, which I hope I convinced you is a very powerful one, and not only about finance. It goes beyond finance. It goes to the ESG components. So just to paraphrase Nike, just do it. Last point, I think, and this one, you know, we cannot talk about the HLF-CMU, but I really hope the HLF-CMU report will push this. One thing I said, one word, my last word, Rainer, that's households. I think there is also another key stakeholder to be educated on equities. It's the governments. And I have one additional call. It's that governments, EU governments, EU public authorities should consider, alongside the existing favored tool to cope with the economic crisis, which is guaranteed loans to distressed companies by the COVID-19 induced crisis. Alongside this, they should consider equity infusion in distressed companies, airlines, for example. I remind you that this has been done very pragmatically by some member states in 2008, with the crisis of 2008, with banks, and UK banks, for example. And this has proven to be a very effective way to save companies, and in the medium term, much less costly for the taxpayer than the loans. Thank you.
Well, thank you very much, Guillaume. And last but not least, it's a pleasure to introduce Petr Koblic, FESE President and the CEO of the Prague Stock Exchange. And Petr has worked many years in banking and brokerage, and obviously in market infrastructure, being the CEO of the Stock Exchange for many years. So, Petr, you're also a member of the High Level Forum. What can exchanges do to help re-equitizing the markets?
It's quite a difficult, first of all, good morning to everybody. It's quite a difficult position to speak after those four speakers who basically said everything, and we can close it here and just go back to work, because I basically agree to 100% what was said. So let me probably start from a little bit different angle, a little bit of report what has happened during the COVID crisis on the exchanges. With the performance of the exchanges during the crisis, and perhaps more importantly, share my views of what we have to do to support the economy and recovering from the situation. Exchanges as highly regulated entities have shown quite high operational resilience, and it is not only a choice for us, it is really a commitment and requirement by all exchanges. Exchanges have focused all their resources on making market work effectively to fulfill their economic role and support the financial stability, allowing for correct valuations, risk management, and liquidity management for economic citizens. And during the peak of the crisis, when volatility was extremely high, the financial sector defended their decision to keep markets open. There was a discussion about that, and we are very happy that the clearly correct decision was taken, and I strongly believe it helped to prevent further chaos and panic. Correct valuation of assets, liquidity, and credit are important in the short term, but this is a crisis where ultimately we need solvency, and in other words, we would need to recapitalize the economy with the equity. I have to touch on that with that respect. One short-term point. There has been a MiFID review. There has been deadline last week, and don't worry, I will not read the 90 pages or so of the responses we had to this in this process. But let me maybe raise a few important topics which was prompted by our members. And there are also some quick fixes to it. First, fair competition and market structure. It is crucial that the design of the equity market structure takes a bigger priority than it has now. Restricting SI trading, for example, or off-lit markets trading for us is important, and it will increase the robustness of price formation. In April, we actually witnessed one software accident in one of the major European exchanges, and this unfortunate event brought us another proof of importance of price formation. When the exchange market was silent, all other, I have to say, price-taking markets were completely dead. So there is a proof of ultimate importance of the lit exchange market. Another point is consolidated tape. We spent hours on it in a high-level forum, and I can say for anything meaningful to occur in this area, we should first improve the off-venue data quality, covering all the execution, which are run in various platforms. For derivatives, there is this unfortunate non-discriminatory access, which is still discussed and probably not well addressed in the moment. I believe this is the wrong policy, both within the single market and also for EU competitiveness and positioning in a global market. We need here a really quick fix. And last on this MiFID, SME, I personally do not understand why we are still discussing the problem of the research. There is the argument that it's not 100% proof that MiFID II caused decrease in the number of research in SMEs, but the number is decreasing. Okay, if it was not caused by MiFID, it was accelerated by MiFID, but I don't see a reason why not to elevate this problematic, and why not to allow small brokers, especially in the smaller market ecosystems, to send SME research to the fund managers without having established a research contract with them. We need some creativity here. So what else can exchanges do to support recapitalization of the economy through IPOs? It was said by the speakers before me that the banking system definitely play a pivotal role in ensuring immediate liquidity to the markets. There are a lot of the cash in the banking sector. There's no interest, but so far haven't been mobilized to finance the EU real economy. I think we have to think about what we're going to do more in the long run. EU needs to be ambitious and aim at significantly increasing size of equity financing. I strongly believe that the basic topics for EU capital market is to get more companies public. This has to be a major dogma, and everything else is just either implication of this, or on the other hand is creating condition to make it happen. But the major dogma would be to have more of our economy on the public market. EU, in its initiative over the last 20 years, envisaged the proportion of equity financing in EU dramatically improve. We all know the results. The numbers of publicly traded companies in Europe dropped by almost 50% in the last 20 years. So let me again stress the reason why it is important to have a strong public capital market. Some of them are clear, some of them are a little bit probably new view. Financing by equity has to increase in its proportion to debt in order to decrease the debt burden in Europe. We all know those numbers, 50-50 in the United States, 90-10 in Europe. We simply finally have to do something in this area. Innovative business projects, mainly in SME world, could not be financed by debt. Equity is the only option. This is why US tech companies lead the world in digital business. And we just heard what David was saying about the IT companies. Europe doesn't have any company in top 15 tech companies, if I understood it right, David. I would even say more funny, the biggest European company by market cap is a handbag producer. Just just describe, where we stand as a European economy. With all the respect to this company, but we need the tech companies to be the biggest European companies. Third, pension funds need long-term investment to achieve reasonable returns. Guillaume was speaking about that, Fabrice was speaking about that. We need our pensioners to grow their savings, to let their savings grow with the growing economy. And that comes another point. EU citizens have to be invested in the real economy, directly or through mutual funds or through exchange-traded funds, in order to keep their belief in participation and participative capitalism on the growth of the economy and on the democratic values in the end. We also have to remember that public companies are more transparent and therefore more under deeper public control. We definitely want that European companies are in the public markets rather than in the hands of outside of Europe sovereign wealth funds or some private equity funds from Caribbean. That's also have an ESG consequence. The more transparent companies can easily report ESG requirements, and we will have a much better overview about the ESG topic. And last, the valuation delivered by the public capital market are crucial for all the other segments of the financial markets, above all for risk management. For example, the private equity investment rarely brings the valuations available to the market, and you cannot value the transaction, for example, in M&A or equity capital market based on the private equity transactions. You need public market and strong public markets to be able to know the valuations of the companies. So let me conclude. I like what David said, and we see it in a high-level forum on every meeting. We as experts can agree on a 95% of the topics. However, we have to somehow convince at least 50% of the politicians to sign up to our plan. And that's going to be far more difficult than agree 95% in high-level forum. For this, we have to deliver a simple story, a PR story. My lobbyists here are saying, that to be successful with the politicians, you have to deliver one-page A4 printed in font 14. That's about it, what you can deliver as a story. I probably would not go so far. There are very clever politicians around the European Union, which I met. However, the simple story, the simple PR messages, which would be delivered in a correct way, in a correct timing, are very important. And it is also very important to say what we need and what we actually don't need, what is not so important. And this is very important. Somebody as well said that there are a lot of the bureaucrats around which have their feelings, what is important. They are living in their box and they think that this thing they are working on for the last 3 years is most important thing. We have to tell them, no, you are wrong, it's not. We have to speak about more out of the box. We will see some departures of listed companies due to nationalization, rescues from the market. However, these companies should be supported in their journey back to the market via IPOs as soon as possible. I hope those funds which are now prepared by European Union will help not only to save the companies, but to return them to the market in due course. Equity is a game changer, and policymakers need to think how to support equity investments from citizens into the real economy. We need to simplify the company's track to the market, and we need to make life of listed companies cheaper, lead my ribs, cheaper, less bureaucratic and less risky. Here I'm aiming at MAR, for example. We can get there providing we listen to each other and we work together. Thank you very much.
Well, thank you. And I think if I listen to all of you, as you just said, Petr, we agree on 95% probably of the issues, and there's left and right a little bit to change. But I think the big question is, how can we get a political agreement on a very ambitious probably much stronger integration of European capital markets. So probably a much stronger ambition on CMU, where the member states are willing to do more together. And we haven't discussed some of the areas like taxation, insolvency, accounting, etc., where obviously the national states still hold the pen and not the Commission. And these are the difficult ones. So maybe reactions, and Sean, maybe you go first. What can we do as an industry to support and convince politicians? Is it the A4 sheet that Petr was saying? Is it that plan David was saying? What is really that industry can do to help? I think that the right thing is being done this time around.
Well, thanks, Rainer. I must say, all very interesting comments. I mean, I think it's right that at technical level there is more agreement. I'm not sure it's 95%, but it is more agreement. But let's not be naive that a lot of the differences that arise at political level have their origins at technical level. It is not that politicians have an agenda of their own for CMU. It is that they are fed information from a technical level, and there are different interests in the market. So I think it is very important that we get technical agreement, okay? Because this will, I think, narrow the differences at political level as well. So this is good to hear that we are converging, and I hope we continue to converge. I would agree. I mean, I will not comment on the David has all ambition you want to do, but as you have mentioned yourself, we are now working in a capital market that will cross many disciplines. So it's not just about the economics, it's about law, it's about accounting, it's about taxation, it's about supervision. So there's a lot of very politically sensitive issues which will have to be handled, and they'll have to be handled by different councils, different ministers within cabinets. So you really need high-level political support. If you think back to the euro, what drove the euro was that there was very high-level political support. Exactly. And by that I mean European Council level political support. There was an agreement we should have the euro, and therefore we had it. Another comment I want to make is about long-term investment, where I think we have all, and David will know, going back to his time and my time a long time ago, trying to push this. And we will look at ways in which we can improve long-term investment, and some measures, some issues have been mentioned around Solvency II, etc. So one point I want to make here, however, is that we have to be careful that in learning the lessons of this crisis, we don't unlearn the lessons of the last one. And this is the tricky balance we have to strike. We know what we need to do for this one. We have to do it in a way that does not undermine the sort of resilience of the reforms we put in place after the last one. And that is a sort of balancing act we have to find. We're trying to, and going to be difficult, going to present us, I think, with some interesting trade. On sustainable finance, I can only just agree. I find it rather paradoxical to have locked down economies based on science around medicine, but we seem less willing to basically take measures based on science around climate. They're both catastrophic events. One is almost very immediate, the other one is a little bit longer, but if we don't respond to it now, it'll be every bit as catastrophic down the line. So I don't think this trade-off between recovery speed and recovery sustainability is real, frankly. I think it's there is no trade-off there. Digitalization is a no-brainer. I think the one perhaps positive you get from all of this lockdown and economic damage that's been done is that a lot of the inertia in the system around digitalization has been taken out. I myself am a testament to this. I am now fully wedded to my technological environment. I'm not going to go back. This is for me. I'm going paperless, for sure. And I think that's across the economy. But it is very worrying that on all of these platforms that we are talking, and I do a lot of talking on platforms, maybe 1 in 10 is based in Europe. I am using a platform given to me by a US provider, which is a bit, as David said, a bit worrying. On the demand side, that Guillaume mentioned retail, absolutely. I think we do have to make sure that as we bring them into this slightly more risky environment relative to bank deposits, that we protect them as well as we can. It is not politically viable, I think, to bring retail into the capital markets, into a world where, of course, the risk-reward trade-off is different, but without giving them this, an adequate level of protection. It just won't work. I mentioned that there is an equity culture around retail. It's not going to be that easy to address. I think we can do it in ways that you've said. Employee share ownership, of course, goes much capital markets, socioeconomic discussion as well. And we'll make it a big issue well beyond my pay scale or well beyond my scope of activity. But we must also be aware that on the investee side, on the SME side, there has traditionally been a lot of resistance to equity investments because of what it implies for ownership. And so I think a degree of equity culture has to be addressed there also, particularly among the smaller companies who really have in the past been a bit resistant to equity investment and have themselves preferred debt because, as I said, they retain control and education there. But we are aware of this. We're aware of the late private equity stage problems. The president actually mentioned this IPO fund in our own priority back last December. So we have pinned that one down.
John, we're
doing the review. I think I've heard the points. Have I yet? Can you hear me?
Yeah, you just come back. You were out for about 20-30 seconds.
I will not go back over it again. So I can really stop there. As I said, I'm encouraged by the degree of technical agreement. I agree we need political agreement, but I will tell you, if we do not get a high degree of technical agreement, this is a precondition for what David is talking about. We will have to go further, but without technical agreement, there won't be the political consensus that you want.
Fabrice and then David, maybe you want to react.
Yes, just a quick one. I'm very happy to hear that we have technical agreement, which is necessary to get somewhere. But now, speaking about high-level political agreement, then you need to put yourself in the shoes of high-level politicians. And you will not convince them with a list of 16 technical issues. That will not be enough for them to take bold decisions. So I think we need to work on the purpose of the CMU, something that they can explain back to their capitals, to the citizens, and to the entrepreneurs, and to their lead economies. But this is something they need is, what is the whole purpose of this? To get back and say, I have a capital market number 2 plan will not be sufficient. They need something that speaks to citizens. That's why think about changing the name, because that will give and show the purpose of the whole thing. And there you will get a political agreement, because they can explain it.
David, you want to react?
Yes, I mean, I think what Sean says is right. We have to show technical convergence. I do think it's really quite high, except in one area, which involves the structure of future supervision. I think everybody, there's the federal model or hub and spokes, and there's a natural inertia of member states to, and some industries not to take the logic of capital markets union. But I think in many of the other areas, Guillaume mentioned and Fabrice, I really do think there's a lot of agreement. I think what Fabrice says is right, that we have to be very convincing here about why we need this and why we need it now and why it's urgent. And for me, there are 2 key elements of this. The first is obviously that it will greatly facilitate economic recovery from this terrible COVID crisis. I think you can make that point. I think Sean made the point very well himself. I think another key issue here is, I mean, if Europe really is going to be, if this is the new green agenda, this is just undeliverable, even more so now without capital markets union, the massive investments that are going to be needed. There's only one way that can be done. It can't be done through the public purse, that's clear. It needs the private sector and it needs efficient capital markets. And the third dimension of all of this is what Fabrice says about citizens. This has to be an attractive proposal for everybody. They have to understand what it means. They have to understand that financial markets will work better for them in the future. I'm not sure I would change it, but I think the emphasis on a capital markets union for all is really crucial. So I'm reasonably optimistic on the technical side, but I'm throwing a Hail Mary to Sean for the politics.
Oh, good. Let me probably say thank you there to our speakers today and the very active debate and contribution. We actually had one question around the political buy-in. I think we asked it. And I want not to forget about one tradition we have, and that is the FESE de la Vega prize. And many of you may know about it. The prize was created in 2000, and I think the idea is to encourage research by young scholars under the age of 40. And every year we have an independent academic and very distinguished jury that awards this prize to an outstanding research paper related to securities market in Europe. And again, as every year, I certainly want to thank the jury very much for their intensive work to carry out selecting the best paper. It's not an easy task, and many of them, I think, are switched on here into the webinar today. And the standards were quite high. The jury reviewed a number of very excellent papers from all over the world, and following 2 rounds of evaluations, I'm very pleased to say that the jury managed to agree on a very worthy winner, and won't keep you in suspense with further ado. The winner of the De La Vega Prize for 2020 has been awarded to Roger Silvers, assistant professor, University of Utah, with his paper which titles "Does Regulatory Cooperation Help Integrate Equity Market?" I think that very much gives testimony to the issue around supervision. And I can see Roger. Hello, Roger. Congratulations, and I offer you to briefly give us an overview on the paper, and I'm going to try to pull up your slide so we can see that. Now I need to deal here with my technology, and let me see that I'm able to do this. All right, you should be able to see the slide.
Okay,
please go ahead.
Can you hear me?
Yes, we can.
Okay, great. Well, first of all, thank you so much, Rainer, and to FESE and the jury for selecting the paper. It's a great award, and I'm very humbled by it. Really grateful for the chance to disseminate my work to people that are actually thinking about some of these same issues. The paper is basically asking the question, does regulatory cooperation help integrate equity markets? And obviously, we've had a lot of discussion about that is maybe more detailed than I'm used to, but I think it's worth sort of backing up and setting the stage to understand, how do academics think about market integration? Well, basically, we have a number of benefits that we would propose that arise out of integration. From the perspective of an investor, obviously, you can diversify across borders, and that provides certain benefits to the portfolio holdings of the investor. From the perspective of firms, you can access deeper and cheaper capital markets, which can help you fund growth, as was mentioned earlier in the webinar. But one of the things that's really interesting, I think, from an academic point of view, is that despite the benefits of integration, can you hear me?
We can hear you, but we lost your picture, I think, for the moment. No, I can still see you. No, I got you.
No worries. So basically, one of the things that's very interesting that arises out of this discussion is that the home bias puzzle, which is essentially that investors all over the globe tend to overweight their local firms in their portfolios. And so it's kind of an odd thing that despite these benefits of integration, we don't really see empirical patterns that would match these types of benefits. And so there are basically economic frictions that have been proposed, things like capital controls, taxes, transaction costs, and so forth. What this paper is doing is really backing up, and rather than looking at a specific type of economic friction, it's looking at regulatory cooperation in general. And so I think it's useful to think about, well, why would regulatory cooperation help integrate capital markets? Well, the first reason that I propose is that it's going to enhance cross-border enforcement. Obviously, David Wright, being at IOSCO, has done quite a bit of work on this in his past. But it's important to protect investors. The second reason is that when there's learning and consensus building and shared experiences, you can potentially provide better regulatory decisions, right? You get to leverage all of these different experiences that regulators have had. And then finally, there's an opportunity to reduce a lot of the regulatory red tape that's associated with cross-border trading and investment activities. So I won't get into all of the sort of nitty-gritty technical details. There are many of those, but you can check out the paper if you're interested. But kind of the punchline of the paper is that indeed market integration is partially dependent on regulatory integration. And what I find is that there's a $1.8 trillion reallocation of funds across borders. And that has welfare effects for investors and firms at the country level and beyond. So if anybody's interested in the paper, please don't feel hesitant to reach out. My contact information is there, and executive summaries are also available. So thank you so much.
Well, thank you, Roger, and congratulations again. And for those in the webinar interested to see the paper, it will be published on the FESE website. We also will do a press release today. And we hope to meet you next year at the FESE convention in person, which obviously this year was not possible. Let me also briefly announce that the next webinar we're going to do will be on the 9th of June at noon at 12 o'clock, and invitations will go out shortly. It will be on MiFID. And I think to conclude, maybe I think we all are realizing we're living in very challenging times. And in my view, the answers of our time can be less and less given by national states alone, but they require unity. And Roger, your part is testimony. But I think when we're talking about capital market union, that's very much what we're realizing. I think it is in our generation where we will decide on the future of Europe, the health, the prosperity, the sustainability, the digital self-determination, and ultimately, and I think that was mentioned by quite a few of you, that will mean the sovereignty of Europe and for the generations to come. And I think after what I heard today, let me end with a stolen and slightly altered quote from Kennedy that should be, I think, an obligation to all of us. Ask not what your Europe can do for you, ask what you can do for Europe. And I think that's maybe something where I very, very often have to think out when about all those help packages is being discussed. I think we need to more think what can we do jointly together rather than expecting only something from the central to be sent. So I think it's, for me, ask not what your Europe can do for you, ask what you can do for Europe. Thank you very much for everybody.